Most high-income earners are stuck listening to the same boring advice. Max out your IRA, do a Roth conversion, stick to a budget. This advice is boring and it's kind of sad. I'm sorry, but I think that's just a wrong approach for ambitious people. That is retirement dinner seminar level thinking. Sure, maybe it saves you a few $1,000, fine. But it's not gonna move the needle on ambitious wealth. If you make real money, traditional financial advice is pretty irrelevant. Our most successful clients are not asking whether the IRA limit is $7,000 or $7,700 this year. They're asking a much better question. What investment can I make that saves me 6 or perhaps 7 figures in taxes next year? That's the mindset shift. So here's the 3-step order of investing for people who think bigger. Step 1, maximize tax strategies first. Here's where the order flips from what traditional advisors tell you. Most advisors want you chasing retirement accounts. That's going to save you a few $1,000s and lock up your capital for decades. It's not super helpful. High-income earners should instead prioritize the strategies that deliver real tax impact right now. The goal is simple. You want to increase your after-tax capital today so you have more to invest today. Because while we can look to deliver high returns for our clients, most strategies cannot outperform a $200,000 tax savings. So here are some example strategies that are worth pursuing to mitigate your tax bill. 1, bonus depreciation through real estate or a private placement where you're a limited partner, you're a passive investor. 2, a cash balance plan. Maybe you run a small business and can use this as a pension plan, your own personal pension plan to deduct hundreds of thousands of dollars a year. 3, direct indexing with a long-short overlay that's going to generate systematic large capital losses for you each and every year. And most investors do none of those strategies because 90% of high earners invest before they tax plan. They just do simple stocks and bonds because that's what their advisor tells them to do because it's very simple to manage. And this is the biggest mistake we see in wealth creation. If you've ever studied Berkshire Hathaway, the entire structure of the firm was designed to mitigate taxes first. Berkshire is known as the greatest investment firm ever created, and yet they obsessed over tax strategy. This one shift in mindset separates ambitious investors from everyone else. Step 2, you need to automate 10 to 20% of your income into investments each month. Now, assuming you don't have massive debt, step 2 is just to make sure that you're consistently adding new money to your brokerage account every month. And so before anything else, you want to automate these savings via dollar cost averaging into the stock market. Because if you have a 40+ year investment horizon, the goal isn't to time the market, it's time in the market. You want to focus on share accumulation. You don't want to focus on trying to nail the perfect entry point. You just want to keep buying on a regular basis to get more and more exposure to the best companies in the world. This automated investment into the market should be something that hits every month without you having to think about it. This is also an incredibly effective money management system. I don't know about you, but I hate budgets. I don't like thinking about, we're running out of money this month to spend on our lifestyle because budgets are depressing. Nobody wants to tell their spouse that it's pasta night again because you've maxed out of the restaurant budget in August. And please, please do not ever skip a vacation with the kids while they're young over money, over this budget matter. If you're a high earner watching this video, you can make it work. You can make that vacation happen. And please don't get me started on putting cash in various envelopes each month. That is not how high earners should be living. Candidly, you should be thinking about growth opportunities. How do I double my income next year? How do I 10x my net worth in 5 years? You shouldn't be obsessing about how to cut down the grocery bill. If you've ever said the words, we have to cut back on our fruit this month, please stop. It costs what it costs. So let's focus on growing your top line. Because if you can keep growing your revenue and you can keep making new investments and get those lined up right, none of these minor expenses are going to matter. Compound interest should make those bills rounding errors in the fullness of time. But you have to start, and it has to be automatic. You want to automate 15 to 20% if possible. And then the rest of your income that month is fair game. If you have a surplus that month, go ahead and blow it on whatever you want. Live your life, travel, build your business, take opportunities, spend whatever is left guilt-free because you've paid yourself first. And this is the foundation that lets you play offense everywhere else in your financial life. All right, step 3, add private market investments for real separation. Once your core stock portfolio is in place, then you want to add private market investments into the picture. This is where accredited investors typically create the gap between good and exceptional outcomes. Here are a couple examples. Maybe you want to add private debt for high monthly income, and it's going to be at an interest rate that dramatically exceeds bond interest rates. Maybe you want to add private equity, real estate for tax benefits and durable income, secondaries, which is buying private equity and venture capital funds on the secondary market. Basically, you're providing liquidity for other investors, so you get a discount. These are all high-quality strategies. In institutional portfolios, institutional investors often allocate 40 to 60% of their portfolio to these private market strategies, while most individual investors are only at around 2 to 3% in private markets. So why do the wealthiest families and institutions have so much allocated to private markets where regular investors, have very little? Here's a few reasons. Number one, the ultra-wealthy know that private equity has historically delivered outsized returns. There is still alpha potential available in the private market, whereas 95% of public market stock pickers underperform the S&P every year. Case in point, private equity has generated 3 to 5% in excess returns annually over the last 15 years over the stock market. Number two, adding private investments reduces the volatility, right? It lowers the variability of that investment in an investor's portfolio. This makes it easier to deal with during downturns, and it's easier to stay invested for the long term. We all know that the path to real wealth is to stay disciplined in the face of large downturns, stay invested. That effect is most dramatic when you have a 100% stock portfolio versus one that includes private investments, which once again reduce the volatility in the portfolio. Number three, lastly, so many investors don't own private market investments because their financial advisors either don't know how to evaluate them, don't have access to them, or think it's harder for them to manage those versus stocks and traditional bonds. And so either way, this is a problem, which should probably cause clients to reevaluate their advisor relationship. Unfortunately, most investors invest by accident, often sporadically with little thought or effort. This is odd considering that over time, their investments should compound to make them far more money than their paycheck or business ever could. Now contrast this to ambitious families who are investing with purpose and intention. They invest 15 to 20% of their income each month. They set it up on autopilot so they never miss a single month. And then they layer in private market investments for tax advantage and outsized return potential. This is the order that high income earners follow. And so if you want an investment system built around that framework, reach out to Evergreen Capital. You can go ahead and apply for a strategy call below. Thanks for watching.